Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're just going to have two segments, keep it light on the econ side. The first one is going to look at the global economic data in terms of high frequency, mobility, GDP estimates, and what's happening with the rollout of the vaccine, and then going a little bit deeper into the U.S., what are some of the U.S. economic drivers. And then the second part is going to be Asian trade, looking at Asian data with a bigger focus on what is trade really telling us into the new year. So again, this is coming out on New Year's Eve, so we hope you had a great holiday. We hope you have a happy new year, and we're going to be excited to see you in 2021. So please like, share, subscribe. We appreciate your support getting us to this point, so your continued support is always appreciated. So when we look at some of the adjustments that we've seen in GDP, this is from Focus Economics, and we always talk about some of the different things that we're seeing, and some of the data has gotten worse for the EU. Some of the data has gotten a little bit better for the US. But again, we always like to talk about where we were in 2019 into 2020. And when we look at the world level, there's an expected to be a fairly strong snapback in Q1. And that's where we get hung up in terms of, what is Q1 actually going to look like on a global level? Because when you look at the BRICS nation, China is expected to have this massive 16.8% growth. And given Q1 is a fairly easy comp, given the fact that their Q1 was down 6.8%. But when we look at the again adjustment of data points to try to get to that point, they've taken down 2019, where instead of it being 6.1%, it was actually 6%. So they actually took down 2019 GDP as they continue to rewrite where 2019 ended to try to make 2020 look better. But by making 2020 look better, does 2021 look worse? Because as we keep talking about, there's a difference between a supply and demand recovery. And so far, a lot of the trade has been export driven with a limited amount of imports, which again has been kind of the tale of two cities, as we continue to see that in Europe, in other parts of Asia, as we'll talk about in segment 2. And it comes back down to the consumer. So, okay, let's take the US, which the expectation is for 2021 to be negative 0.7%. And in our estimate, it's going to be something a little bit worse, closer to over 1% down, closer to about 1.5%. But the issue is going to be how big is the stimulus check? Because the stimulus check is going to make that adjustment for us in terms of, is it only the 600? Then the bump will be much lower because things are going to adjust. Is it 2,000? We know $1,200 did a lot for the consumer in terms of pushing, increasing spending. But now, as we are at a much different spot where jobs still haven't come back, we still see a slowdown across the board on a jobs level. When we look at small businesses, when we look at a home-based working data, hours worked, they're all under a lot of pressure. So even if it's 2,000, how much of that is spent versus saved, given the longevity or the pressure we've continued to see on the jobs front? And then, as we know, the Euro areas continue to get worse with additional lockdowns. As we were talking previously before we started filming, instead of announcing a new UK lockdown, they essentially just went into tier 4 across the board. Again, all of these issues, and when we look at the UK versus France, they're typically pretty close to each other in terms of when they extend lockdown. So right now, France has been very adamant they will not extend, but we've seen extensions all around France. So it will be likely to see something similar. This will all just put additional weight on overall activity and just where the global economy sits, because right now there's an expectation for Q1 2021 to see growth of 2%. Again, if you just look at the numbers, all of that is driven by China. So the question is, can China really deliver that kind of growth? And it's really coming back down to, okay, let's look at COVID-19 vaccination doses. Now, this is administered per 100 people as of December 30th. And now, just to clarify, and my mother, who already got her first dose, you have to think this is saying this is counted as a single dose, and a person is considered vaccinated when you get your second dose, which is a 2 to 3 week period, and you have to show up to get your second dose at that time period. And it has to be the same one. So if you get Pfizer, you have to stay with Pfizer. If you get the other one, which is escaping me at the moment, the Oxford, you have to get the Oxford again. Like, you can't go back and forth. They're very specific. So these are also things that could limit in terms of, okay, well, what's the logistics of getting the additional flow, the additional vaccines to the locations? So these are things that will continue to hit. And obviously Israel, Bahrain continue to be accelerated, but again, smaller countries, smaller sets of people. It's easier to do versus the larger land masses, larger countries. U.S. is at about 0.64. And the idea is to try to get as close to as possible to try to get to the level of herd immunity, if you will. And just based on some of this data points, we won't get there till about July based on vaccinations, who has already had it. So the expectation right now is to get another increase in COVID cases through the end of January, and then another surge that like we saw in March during that change of season. These are things that we're going to have to watch in terms of, again, where activity sits and what do things look like as we have a rise in zombie companies, as we have more defaults, as March is a pivotal month in terms of when a lot of debt starts to come due. These are the things that we continue to look at. But on a global level, there is a big change. And we did a big show on it. I would recommend going back and watching it because I think we did a good job of highlighting extreme poverty, and that's forecast of the global poverty rate at $1.90 a day. And as we talk about in segment 2, when we've seen a huge increase in grain prices as we hit 6, 9, 10-year highs, depending on country, depending on product. Again, that's going to push and cause more problems for those as the pre-COVID-19 rate of extreme poverty continued to go down. And now we're getting a big shift up as we head into, but even the baseline rate, the downside rate, you can see that they're fairly similar. And as you have the dollar coming under pressure and as you have grain prices going up, this is only going to get worse. I mean, when we look in the U.S., and we talked about this at the very beginning of COVID as food inflation was a big topic for us. Food banks continue to run out of food in the U.S. We're seeing more and more people becoming. I think before this it was 1 in 7. Now we're up to 2 in 7 that just don't know where the next meal is coming from in the U.S. alone. I mean, extreme poverty is usually talking more about Asian nations, African nations, and we're seeing less and less food insecurity in the U.S. as well. These are things that we like to talk about just to bring awareness, but also to highlight, where the issues are going to arise, why we continue to think there's going to be a geopolitical upheaval, because when you don't eat, when you can't eat, this is when people are going to lash out and the bigger issues come to light. And even though we have these extreme issues, we still have stocks at all-time highs, home prices at all-time highs, corporate bond yields at all-time lows, mortgage rates at all-time lows, and the Fed saying we need many more years of 0% rates and bond buying to pump up the market and increase inflation. I don't know what bubble they're looking to reinflate, but those are a lot of bubbles that are currently reinflated, even though we have additional lockdowns, we have economic data at some of the worst it's ever been, and continued poverty on a global level, and food insecurity increasing exponentially in the U.S. as grain prices continue to go to all-time highs. Soybeans now back above 1,300, which is $1.30. Corn up another 9, wheat up another 23. I mean, there is a big problem that has to be addressed, and we continue to see the pump up. And we've covered velocity money, inflation, what does it mean in other shows. So again, this is not something that's going away overnight, but yet we continue to get this mantra of, we need more. And it's like, okay, if I drink oil and eat airline tickets, I'm fine because there's deflation for me. But if I buy food, eat food, and have healthcare, well, there's inflation. Right? And we'll talk about home prices, which have seen a 7.5% increase in price, which is their inflation target is 2%, and the home prices are at 7.5%. Again, what inflation, what bubble do you want to inflate next? And it's just, we continue to see this driving higher, which is concerning to say the least. But now as we look at daily activity indicators, we have our normal holiday slowdown. Again, nothing crazy in terms of the slowdown. The issue is going to be how quickly do we get a bounce back up, and at what level do we start to flatline and kind of roll over? Because typically January and February are typically a little bit slower. And now with renewed lockdowns, not only in the U.S. with the hospitalization rates remaining at record highs, but also issues within Europe. This is why advanced economies are going to continue to they'll get back to where we started, but it's just how quickly can we get back? Is it going to be a quick snapback, or is it going to be something a little bit flatter over a longer period of time? And again, emerging markets, something similar. And when we look at emerging markets, when we look at the problems that we continue to see, and this is, Korea is obviously not within that bubble, but Korea, Japan have additional lockdowns coming in. Japan is cutting all new international, no one can come in internationally for the month of January. We have continued issues in Korea with slowdowns. And again, these are things that are going to continue to reverberate through the system and see additional problems, which again is going to weigh on just general economic growth on a global footprint. And this is just showing the reductions overall on the emerging market level. And now, we'll see that snapback, but again, India is the one that we continue to talk about, where things are starting to get a little bit worse. Things are rolling over a little bit. We had that nice run into Diwali and the festival season, and then, we kind of normalize around 80, and now we're going back below that 80 level, where Chile, some of the other, Brazil, some of these others will start to snap back. But China is the one that we continue to talk about extensively, where they continue to adjust numbers and make things look better. And again, these are things that continue to be a problem as we come into the new year. And this is just looking at Europe a little differently. So this is kind of looking at not only Europe, but also, large parts of the G7. And you can see the extreme downward move back to the lows that we saw in March and April. Again, more normal. It's just, what does the recovery look like, and how slow is the recovery, as people have already bought their goods for Christmas. People have already bought things. And remember, before Christmas, this rally or this recovery in activity captured people doing more for the holidays. So now that's all gone. That little bump is over. So does stimulus provide that extra uplift to get us back to where we were prior to the holidays? And it's going to come down to size, how quickly is it disseminated, and what do people do with it. And based on the early indications we're seeing, it's going to go into savings. It's going to go to supply for food, which again will give us some of that recovery, but it just won't bring us as quickly to where we dropped off as it should, which is why we remain concerned in January and what Q1 numbers will look like. And that's why, and this I thought this was a good chart that came out from Bloomberg, breaking down from the Bureau of Labor Statistics of U.S. stocks continue to go higher, but U.S. employment continues to be negative. And this is what we continue to talk about, where we had a step change throughout the year, but now we have flatlined. Now, don't get me wrong, end of November, December, dead points for hiring. First half of January, dead time for hiring. We normally see a big pickup into the end of January, into February, as people get their bonuses, maybe make some adjustments. But it's just, we're not seeing the same type of recovery, because the biggest issue or the biggest detriment right now is at the higher end of the unemployment standard, where it's going to be much harder to get a job that's paying you $250, $300 if you lost it. And we've already seen some of the early movers at the first quartile or the lowest quartile of salary come back. So again, it's going to be difficult to see kind of this snapback overall, which is why when we look at, how are people investing? Well, investors borrowing against their securities reached a record $722 billion last month, climbing alongside the stock market. So people are taking what they've made in the stock market and they're borrowing against it. They're using leverage. They're maxing out their leverage to put more risk to the upside. And again, this is that leverage to the upside that we continue to talk about, where the put call skew, everyone likes to talk about it, but it can go lower and just like volatility, when everyone talks about, well, volatility is so low, it can go lower, it can go higher. There continues to be this push to just double, triple down. And at some point, it's going to backfire. And when it backfires, do you have enough in margin cushion to adjust that, or is there going to be this forced selling? And as there's forced selling, then the momentum shifts, and this could be a big headwind. But as you can see back here in 2018, a lot of guys were borrowing against their margin, and they did it for months. And so I'm not saying that it spikes up and spikes back down. Depending on how we sit, we could see people continuously borrowing against their winnings and trying to double, triple down instead of maybe taking some profits and taking some stuff off the table. And this is looking at, again, the U.S. high frequency data dashboard. Things continued to get worse into December 25th. We had the lockdown index, which is back in the 70s. That is not going down, as we've talked about, with schools maintaining either 2 to 4 weeks of remote learning to try to avoid anyone that may have gotten infected over the holidays. These are things that are going to continue to weigh. And jobless claims continue to remain elevated, as we've highlighted constantly. It comes out tomorrow, so unfortunately we won't be able to cover it till the next week with the new data points. But again, these are things that are continuing to be a problem overall, and just is going to weigh on activity. But then when we look at I thought this chart was funny in how they named it, the money machine, where here in 2008 into 2009, you can see the Fed taking the activity, increasing the balance sheet in order to stimulate. But then after 2019, when we technically came out of a recession, you can see that we had a continuation of easing that really carried us through not only the end of the financial crisis, but well into the European crisis. Then things started to kind of normalize a bit as 2018 got much better. 2018, we had peak GDP growth. We had a lot of growth overall, which was getting better. And then 2019, again, when we started to get concerned, was that July of 2019. And then we got extra concerned when all of a sudden they came in and started to back the repo rate. And that's when we see the expansion. And then obviously March 15th was when the Fed came out on that Sunday, when we had 7 massive hedge funds that were completely insolvent because they were levered long, have to get bailed out, which is why the benchmark rate was cut by a full percentage point, and we had a 75% move to the upside. And if you look at just the difference between 2008, 2009, and today, that's the law of diminishing returns. You needed to make up for the fact that we've been easing nonstop from 1 trillion to 4.5 trillion, back down to 3.7 trillion. And now we went from 3.7 trillion to 7.4 trillion. So we've added about $4 trillion to the Fed balance sheet, but that doesn't mean it's getting to people, because the banks are the intermediary. And if the banks are lending to higher, people with higher credit ratings, or maybe not lending at all, or shrinking it doesn't mean it's getting. So the balance sheet is growing, but as we've talked about with the velocity of money, with where the life cycle of a dollar and where it sits, it's not getting to the market, which, again, it's getting there in some ways in terms of inflation in some spots, but deflation in others. And this is where we continue to see this expansion. And just based on what we've talked about over the last, 6 months in either segment 1 or segment 2 of our econ show, we talk about what the Fed's planning on doing. They're still going to be spending or buying $120 billion worth of bonds, which is, again, going to continue to keep this balance sheet extending over the next many months. So cheap credit, keeping companies alive, this is kind of coming to the credit side. So now cheap credit is keeping them alive while earnings don't cover interest expense. Again, this comes back to the zombie company. And they owe a lot of money. So they owe $2 trillion, which is 30% more than 2008 and double last year. So you can see, this is the over-indebted companies. This is weak balance sheets, which have had a strong rally, dash to trash, if you will, as there was a huge grab for beta. and to try to make up this alpha component, because a lot of these weak balance sheet companies trade at a 2-3 time beta to the market to try to make up for alpha that you might have missed, not buying the March lows. But the strong balance sheets, again, continue to outperform as they should. But again, you can see that we had a strong push in the weaker side. And then 1 in 5 of the largest U.S. publicly traded companies are now considered zombies, which again leads to the bigger problem of how healthy is this economy, and where if you're not growing, if you can barely cover, if at all cover interest expense, can you really invest in new manufacturing, invest in new employees? Like, what does this really look like on a recovery side, which is why we continue to remain concerned on what 2021 looks like. And here's just putting it into context. When you look at what $2 trillion looks like versus 2008, which was at just above 1.5, and you can see the massive explosion of just the amount of obligations. But this isn't just a U.S. problem. When we shift to Europe, you can see that the shares in zombie companies continue to shift higher as a percent, where they're now about 7% as inflation has dipped down, and in the inflation forecast remained kind of unknown. But as we know, things, you have Portugal, you have Greece, issuing debt at 0%. You have negative yielding debt. Again, this is, enabling them within the ECB as well to go out, issue debt, get some negative, some cheap debt to stay alive and try to get to the other side. And now, when we talk about the U.S., some of the key points here is pending home sales missed to the downside. Not surprising given the pressure in terms of just the holidays, but also just some of the slowdowns with, again, as we've talked about, if you could buy a home, you did buy a home. And it's going to be hard to see the second wave and where that second wave comes from, which is why the pending home sales. Now, don't get me wrong, these are still great numbers. It's just we're starting to see kind of that cooling off. And then the question is going to be, how do we get a rejuvenation in the first quarter? And it's going to be hard to see that. Now, Chicago PMI was a little bit better than expectations, but again, there's a piece to that because wholesale inventories went down. Again, as we go back to the EIA show, when we show you trucking and rail, this is what has to be replenished. Retail inventories month over month were down to 0.7. Again, these are things that are going to have to be replenished. Good for diesel demand. Again, that tailwind, but the PMI. But then at the same time, and this kind of balances out, when we look at Milwaukee ISM report, it slowed from 62 to 56.9. And why is that? Because new orders fell from 77 to 68. You had production fall from 53 to 44. Employment from 53 to 50. Prices went up from 72 to 81. Again, starting to get that inflation as things are slowing. And then supplier deliveries rose to 91 versus 77. Again, trying to get some of this, the delays that we continue to see on the logistical side. Inventories down from 47 to 29. That has to spike back up. These are things that are continuing to come through. And again, the Chicago report purchasers index was expected to be at 58.2, came in at 59.5. But the issues in the underlying are new order slowing, production slowing, employment slowing. These are things that are more leading indicators that show that January, December into January is going to be a tough month or 2 months to try to see some of this kind of things getting back to normal as pressure remains in the system. And that's why when we look at the New York Fed Weekly Economic Index, we're seeing it roll back over to down 2%. Industrial production remains flat, but we see this negative drive as these moves continue to put pressure on what expectations are heading into the new year. And then the dollar index. The dollar index has a record amount of shorts because the view has been short the dollar and go long everything. I mean, there has been, it's just short dollar, long everything else. That's long commodities, that is long stocks, that is long bonds, and short the dollar. Now, we can see that this is what happened in 2011. And you can, just to highlight, you can be down here for an extended period of time. It's just we're getting to extremes, and it's time to kind of take note of what is in your portfolio. Is this a point where I've made a great run, time to take some profits, because you don't want to be the last guy in the movie theater when someone yells fire and everyone's rushing out. So this is something to watch. Or buy protection, whether that's upside calls or in terms of where some of these things are to kind of cap some of your gains into to take some profits. As my old boss used to say, nobody goes broke taking profits. So this is looking at, okay, well, index funds. This is the passive side. So as much as we want to say, look, things have gotten worse, but everyone's gone into passive investment. So when do people wake up from the passive moves? Because index funds have moved, equities, you can see the increase overall, but bonds and other have seen an increase in total net assets as everybody continues to increase their exposure to funds and index funds overall. What does that mean? Well, active equities has seen an outflow of $3 trillion. Passive equities has seen an inflow of $3 trillion. Passive bonds, an increase of $1.5 trillion. Active bonds, an increase of about $800 billion. But the passive equities and bonds is something that we just want to pause and talk about for a second, because if you think about the increase in ETFs, just let's take Tesla for an example. So Tesla's in the S&P 500 as well as 100 or so other ETFs. If that stock were to fall 30%, that means that those indexes would naturally fall as well, just because of the large weighting of Tesla in each one. And that's a long way of saying what wakes people up out of passive equities. Because right now, buying the dip has been a huge success. When do you get people to say, oh, this is concerning? Is it a continuous write down? Like, when do people look at their passive holdings and say, I should readjust? Because right now we haven't seen that. Instead, it's been a double down, triple down, which again has kept the market in this perpetual motion higher. And we've seen it go from active equities into other things. And that's why we've seen this net increase in passive flows, which is going to be interesting, because it's going to be hard to get a downturn in stock prices unless we get some movement on the passive side. Now, when we look at, what could wake people up to that, is it the Dallas Fed? So Dallas Fed manufacturing outlook was estimated to be 11.6, came in an actual of 9.7. Again, this kind of natural, slowdown that we continue to see, because this was for November, and the underlying continue to point to some pressure into the end of the year. Now, to wrap up on some things is going to be really, okay, let's look at Case-Shiller. So Case-Shiller, looking at 20 cities, the prices are up year over year 7.95%, 8% higher year over year. So when you think about, okay, well, I thought inflation was supposed to be at 2%, and now we're getting, the increase in home prices at 8%. This is going to continue to push that inflation conversation higher, or it should. But let's look at some of the technicals of how that is indicative of where things are. So this is looking at some of the metro areas, October and September of 2020. You can see the Fed inflation target at 2%. And where we are from September, so you can see September well over the 2% mark, October well over the September mark, continuing to see that driver across the board, really doesn't matter where. And this is in metro areas, and metro areas continue to see, even though we get this urban to suburban, this is also picking up some suburban areas. The people moving maybe out of New York City into Brooklyn, or Brooklyn into Long Island City, or into Staten Island and Bronx, other areas. We continue to see an increase in prices on a percentage basis, even though likelihood of eviction in the next 2 months continues to increase. But again, it's a tale of two cities. That lower third continues to be under pressure. We have 2 million less than 25,000. We have 1.2 million at this 35,000. We have 800,000 at the 75,000. This is going to put additional pressure on this movement, because these are foreclosures, these are short sales, these are new supply that's going to come into the market when we get some of the rent support. So as we talked about in the stimulus show, $75 billion in back rent is owed. $25 billion is being given in stimulus to help that. There's still a $50 billion gap, which again is expiring in March, going to be in a problem in terms of, okay, well, where do we get ahead of this? And then to kind of wrap up, why doesn't this appear in inflation numbers? And it's because the CPI owner's rent continues to essentially underperformed the Case-Shiller home prices. So what the CPI is using as rent, because rent in these cities has gone down, because you have people rushing out of apartments. You have people move. So rent is dipping, but home prices are exploding. So we should see the rent start, or at least the CPI owner's rent, start to kind of pick up, because more, even though home prices are going up, mortgages, or that are, what's your monthly number that you're paying is coming down, which again is putting pressure on kind of where this CPI owner's rent starts to get this turn, which is why even though home prices are exploding, we're not seeing that reflected in the inflation numbers. So there's the statement that inflation is low and home prices can go higher. And again, this is kind of that tale of two cities, but we've seen this before. Like, look at, as we went from 97 through 08, you had this home prices continue to just trend higher, and CPI owner's rent did nothing. So this isn't something that it can be a power move, is what I'm trying to say. Like, this doesn't have to just stop. This can continue. We think it does stop because of the artificial nature of it, with the restrictions on evictions, the restrictions on foreclosures. As that ends, we'll start to see new supply coming on. We have permits at a record high, or I should say 2011 highs. We have new starts at 2011 highs. These are things that will bring new supply, which will cap some of those prices. But again, rates remaining low will help support some of those prices at the elevated level. And the rents falling in some of these cities will keep that owner's rent kind of stable, and it'll provide the mantra that we don't have inflation, even though anybody who's buying anything that they consume on a regular basis sees it, feels it. And that's why we continue to remain concerned as we head into Q1, as the consumer continues to struggle, even with stimulus coming into the new year.